If you're thinking about investing in real estate, you've probably considered buying houses, single-family homes, and on the other side, investing in multifamily or apartment buildings. I started off in one and ended up in the other, and in this video, I'm going to cover 5 reasons why multifamily is better than single-family home investing. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. And if you don't know me, I'm Seth Ferguson, a 13-year real estate veteran, host of a real estate TV show, host of a real estate investing podcast, and I'm also the author of the real estate book, Sell for More. So let's get right into it and talk about multifamily versus single family. And if you are interested in multifamily real estate, you need to come to the Multifamily Conference. This is happening May 14th and 15th, 2022 in Toronto. We're bringing together investors from all over North America together to listen to the very top speakers in the multifamily space. We've got Rod Cleef, Kevin O'Leary, Richard Wilson, Joel Block, so many top speakers. So I'm really excited about it. So I'll put a link right down in the video. Definitely check it out. We've got some incredible ticket sales happening right now. So let's talk about the first thing. The first reason why multifamily crushes single family home, and it's cash flow. And let me tell you a story. I started off investing in single family homes, like a bungalow, duplex conversion, a condo, a detached house. And what I found was I was equity rich, but cash flow poor. So I had all this equity that I had built up in these properties, but I couldn't access it. I was doing well on the equity side, but cash flow is what makes real estate go around, because cash flow, you need this to cover your debt service payments, you need this to do repairs, and then you also need cash flow to grow your portfolio, because if all your capital is tied up in one property and you can't access it, then how can you grow your portfolio? Because you need that capital to invest in your next property. And this is where multifamily crushes single family because of the scale of it. You have many more units, so your cash flow goes up and it's a whole lot stronger. And this gives you a lot of downside protection, because in economic downturns, multifamily, when you look at all the different commercial asset types, industrial, retail, office space, and multifamily has outperformed the others in the past 2 recessions. So there's no question of a doubt in my mind, if I'm looking to invest my capital, yeah, sure, the upside is what's important, but what's even more important is how the asset performs in the downturns, because you can't lose your investment. That's rule number 1 of investing, and multifamily is where it's at when it comes to cash flow. Reason number 2 is management costs. Anybody who's managed a single family property portfolio knows to pay a property manager to manage your portfolio is going to cost you 10 to 12% of gross rents. And anybody who's investing in hotter markets, whether it's in the United States or Canada, knows that 10 to 12% of gross rents puts you from positive territory or break-even territory to negatively geared, so you're actually losing money every month. And this is one of the problems I see with single family home investing. People will actually buy an asset that's losing money for multiple years in a row. So basically you're putting money into the property in the hopes of future appreciation. And we know that whenever we're banking on making our money on future growth, that's called speculation. That is not investing. And I did a video a long time ago. I wonder if Francis, my editor, can find this. If he can, let's put the link up here to that video, because I talk about the difference between investing and speculating. And most people think they're investing, but they're actually engaging in speculative behavior. So when it comes to multifamily though, management costs get a whole lot better. Oftentimes, depending on the type of property, we can be 3 to 5%, let's say. Plus, the larger properties, if we're dealing with like a 100-unit, 200-unit property, we have full-time staff on site. So here's one of the benefits. With the single-family portfolio, that property manager will be managing hundreds of different properties, and they'll visit that property maybe once every 2 months, or give or take maybe once a quarter, just to check in on things. They're not there all the time. So deferred maintenance issues come up. They're not always there because they've got all these other properties they're managing for 10 to 12%. With these larger multifamily properties, you have on-site staff whose job it is to show up every day and manage the property. So you've got staff in the leasing office, you have full-time maintenance staff. So they are on the property every single day or almost every single day. So which property do you think is going to perform better? The one where you have staff there all the time, so they're on top of every issue, the residents know them, they know who to talk to, or the property manager where they show up once a month, once every 2 months, and it's up to the tenant to alert you. If anybody has experience in single family home tenancy, tenants do not alert you as soon as a problem arises. Oftentimes it's months later in the future. Oh yeah, this got really bad. And all of a sudden you have to rip out all your flooring because they forgot to tell you about the small little leak that they saw 4 months previous. So this is another reason why multifamily is superior to single family home investing. Reason number 3 is financing. And this is a lesson I learned the hard way. I was looking to scale my portfolio. I wanted to grow. I had big real estate goals. And when it comes to single family home investing, the bank, the lender is looking for you, the borrower, to shoulder the debt. So basically you have to qualify using your own income. The bank's not really looking at the property. The bank is looking at you, because if you default, if you stop paying your loan, well, guess what the bank's going to do? Not only will they take the property, but they will also come after all your other assets to make themselves whole. That is how residential financing works. Now, when we flip over to commercial lending with a multifamily property, it's based totally differently. The lender cares about the property first, and then they care about you and your ability to actually manage it. And this is where having a professional property management company who is experienced in that asset class, that type of property, that area, comes into play, because the lender wants to make sure the business of the real estate is well managed and well looked after. You don't necessarily need to have the experience. You just need to have a team that is experienced helping you out and making all those key decisions for you. So when we are financing commercial property, we have recourse and non-recourse debt. And I'll put a link right up here to a video I did explaining all about non-recourse debt. So basically what this means is, with the non-recourse loan, yes, the bank will give you a loan, but they're saying we won't come after all your personal assets. The most we can do is actually take the property off your hands and manage it ourselves, and probably sell it and get it off their balance sheet. But they're not going to come after your personal assets. And this is, as an investor, this is huge, because that really limits your risk. With single family home investing, oftentimes you're basically gambling or throwing the dice, because all your properties are tied together. If one tumbles, then that opens you up for a whole world of hurt. So when it comes to financing, multifamily is far better, because the lender cares about the property, and they're looking to see how much cash flow it produces. They want to learn about your business plan. With residential financing, they just care about you, because they just want to make sure that they can come after you and all your assets so they can get their money back. The cash flow the property produces doesn't really mean very much at all. And if you're looking to learn more about multifamily real estate investing, join my free Facebook group. Links right down below. We have a great group of people always willing to help. So definitely join the group and come say hi. So let's move on to number 4. Reason number 4 is scalability. And I'll go back again to my single family home investing days. So what I did was I have this big goal for real estate investing. And I worked it out. So I would have had to have owned 1,000 houses to hit my real estate goal. Can you imagine owning 1,000 houses, having 1,000 tax bills, 1,000 utility accounts? Well, probably more, because we have multiple accounts for each property. It just gets crazy when you imagine the scale. Plus, how can one person get 1,000 loans for residential property? That's just pure insanity. You don't want to do that. So scalability is something that multifamily gives you. So if you go out and purchase or acquire 100 houses, and then you go out and acquire one 100-unit apartment building, there is a world of difference in terms of the ease of management, the ease of acquisition. On one side, you have to acquire 100 different houses. On the other side, you acquire one property with 100 units. On this side, you have to acquire 100 different loans and fight that process like I just talked about. On this side, you end up with one loan for one property. You deal with one property manager. On this side, you have possibly multiple managers. It's just the scalability factor. If you want to grow big and really do something big with your portfolio and really make an impactful difference, multifamily gives you that scalability factor, whereas single family homes, it is so hard to fight to scale. Like, I fought that battle trying to scale the single family home portfolio. It is incredibly challenging. So multifamily, when you compare the two, multifamily wins hands down when it comes to scaling your portfolio. And I'm going to go into a couple different tangents when I'm talking about structuring. So when I talk about structuring, what are the structures available to us in order to build our business and grow? Well, one thing we need as real estate investors to grow our business is capital. Whether you're investing in single family homes, growing your portfolio, or investing in multifamily homes, we need investor capital to scale. We need to use other people's money because we are the ones with the experience, the track record, the team, the deal flow. And then there's all these other people out there who have money who want to invest with somebody who knows what they're doing. They're doing what they do best day to day. They have their cash that they want to invest and put it to work in a multifamily deal. You have the tax benefits, the cash flow, the appreciation, the downside protection, all of those things that multifamily brings, and even real estate in general, depending on how you set it up. But obviously this is a multifamily channel, so we're talking about multifamily. We have capital. Now, the scale of multifamily allows us to use some more sophisticated structures when it comes to raising capital. And those two structures are syndication, and we have the real estate fund structure. And I've done videos on this before, so I'll put a video link right up here to that video where I talk about the difference between a syndication and a fund. These are very sophisticated structures that Wall Street uses to raise large amounts of capital in a very efficient manner. It's all about efficiency when you're scaling your business. The scale of multifamily and how it's set up allows us to use these structures because we get the cash flow, which investors want, because we have the management efficiencies, which is necessary to run a good business, because we have the better financing options, we have other terms like interest-only periods that helps us cash flow and also divert more money into repairs and renovations to further compress the cap rate and increase the valuation we have. And then we have the scalability factor, so that allows us to grow our portfolio, bringing more investor capital and acquire more properties. So many different benefits that come along with using more sophisticated structures. And one of the things I always like to highlight, because this is a very common misconception, is that if somebody is in a joint venture or a partnership and they're the ones contributing the capital, lots of people call this passive investing. But when it comes down to it, you are an active partner. So if something goes wrong in the deal, you are on the hook just as much as the person who's probably swinging the hammer. There is no passive investing when it comes to partnerships in a single family home deal, or let alone a partnership when it comes to a multifamily property. The only true passive investing comes through syndication and a fund structure, because you have a limited partnership coming in and the risk is limited. Use these structures to afford your investors protections under the law and help them make better investments. These are what these structures do. And if you want to scale your portfolio, you need to master how to raise capital using the syndication and the fund structure. That was a bit of a tangent, but it is so important to realize how we're bringing capital in, how we're bringing investors into the deals, and how the different structures that we employ affect the investors we have with us in the deal. So those are 5 reasons. I could go on for probably another 20 more of why multifamily beats single family homes when it comes to real estate investing. I started off with single family homes like a lot of people, and I quickly realized I could not scale. I could not realize what I wanted to do just sticking with the single family home investing. So if you like this video, if you found this useful, hit the like button, leave a comment, let me know what you think, and until next time, happy investing.